Hello guys, welcome to another video. The market has been recovering consistently in the past few weeks after a better than expected inflation report in the US. As you can see, my portfolio is up a little bit and has around $1,500 more since my last week's update. This is pretty good to see, and I'm trying my best to not get excited when something like this happens, because I think it is important to not get emotionally affected by the short-term gain or losses, so I can pay more attention to the underlying business instead of the stock price. Here is a quote from Mr. Warren Buffett comparing stock investing with buying a farm, and I think the key takeaway is that we investors should not care about the market quotes at all. I have been trying to do this for the past few years, and to be honest, it has been pretty hard to do, especially when there's real money involved. But I'll try my best going forward. That said, in this video, I will cover a recent change I made to my portfolio and share some of my learnings regarding the recent FTX collapse. I didn't touch most of my holdings in the portfolio since there isn't any significant updates for any of my companies, and their business is continuing as usual. I have only sold the ETF, which is ticker symbol XIC, and that one tracks the Canadian market index, and I have replaced it with the US Dividend Appreciation ETF, VGG. There are two reasons for this change. We can take a look at the ETF overview for XIC on the BlackRock website. If we go into the Exposure Breakdowns tab, we can see that this ETF has the most exposure to the financial companies, which I don't want because my portfolio already had enough exposure through my Scotiabank holdings, and that single position takes 15% of the portfolio. Another important consideration is the performance. If we go back to the overview section, and you can see the XIC ETF only delivers about 6.7% compound annual return, which is much lower than the Dividend Appreciation ETF, VGG. If we go to the VGG's ETF overview site, and if we scroll down and goes to the performance section, we can see that this ETF delivers a much higher 13.3% compound return annually. And this is a market-beating return. Another big plus is that the top holdings of this ETF, the VGG, are mostly profitable companies that have great brands and competitive advantages. So if we go to the portfolio section, and look for the top holdings of this fund, we can see that we have the United Health Group as the top holding, which is a top healthcare service company in the US. We also have other strong names like Johnson & Johnson, Microsoft, Visa, Pepsi, and the Coke. These are all extremely strong companies that have increased their dividend consistently in the past decade and are currently sold for a reasonable price. So we can confirm this by looking at the average P ratio of this fund. We can see that here under the portfolio section, the average P ratio is only 20, which I think is not very high because of the high quality of the businesses included in this fund. And that's all the reason why I made the change. And now let's talk about the more interesting topics of the FTX collapse. This FTX collapse was the biggest news in the past few weeks. I've also had hundreds of dollars got stuck on BlockFi, unfortunately, which is a crypto lending platform that has large exposure to the FTX. This incident really reinforced my belief in diversification, especially when dealing with an unregulated crypto platforms. It is important to note that if your account is not government insured, you may lose all of your funds in the case of a bankruptcy of the platform. So please make sure that you cross-check on the FDIC or CDIC's website to see if your bank have your deposits insured. Unfortunately, most crypto firms don't have this coverage. So with this knowledge, I only invested about 2% of my total wealth into crypto, and it is spread across 4 platforms: Celsius, BlockFi, Crypto.com, and the Ledger Code Wallet. And this year it's been crazy. I lost $1,000 in Celsius because of their bankruptcy. And at that time, I actually thought of moving all of my cryptos out of these platforms and put them into my Code Wallet. But then the FTX come out and rescued the BlockFi, and I thought things should be fine. But it wasn't. I guess I'm still too young and naive, and now I've moved all of my remaining cryptos from Crypto.com platform into the cold wallet after all of this drama. So from all of this happened, I learned the following lessons. When dealing with higher risk and unregulated investment options or investments that I have little knowledge of, such as the cryptocurrency, there are 3 principles to follow. The first one is to only invest a small amount that I'm comfortable to lose. And the second one is to diversify as much as possible across different platforms. And the final one is to get out as soon as possible when there are bad news. A recent example would be when the crypto platform Celsius collapsed. If I was cautious enough and moved all of my cryptos out of all other platforms, I would have not lost my principal investment on the BlockFi. And that's all for today's video. Please leave a like and subscribe if you think this is helpful. Thank you so much for watching, and I'll see you in the next one.